Leverage in trading can be an absolutely incredible thing. Not only does it extend the returns by 3 times on a day-to-day basis, but because of daily compounding, it actually extends far beyond 300% returns across the entire time frame. And for the same reason, leverage can be horrible, in this case offering significantly higher volatility and significantly lower returns due to this compounding feature. I've articulated concern regarding this before, but there's a lot more to discuss than just this. There's an amazing paper on this that I would like to base the first part of my discussion on, and this is the formula that leads to this leverage decay, or as they call it here, volatility drag. And here it states that even an ETF with a leverage of 1x does have volatility drag. And it says that the assumption that this volatility drag will drag a leveraged ETF down to zero given enough time is false. And the best part, in my opinion, is this passage. But we know that leverage of 1x is safe to hold forever, even though leverage 1x still has volatility drag. If 1 times leverage is safe, then is 1.01 times leverage safe? What about 1.1, or 2, or 3? Where is the line between safe and unsafe? So by this logic, the fact that our standardized ETFs are 1x leverage is arbitrary, as is 1x. Now the reason things are 1x in the first place is very obvious, of course, because an index seeks to mimic the market cap weight of its underlying, which of course have no leverage rebalancing function. But through an ETF, there is no real reason that 1x is the norm or that 1x is the best, just because higher or lower ratios exhibit that volatility drag. In fact, if we take a look at the effects of leverage below 1x, we see the opposite effect of volatility drag. We have to use larger differences to make it obvious, but it is there. If an ETF goes from 100 to 50 to 100, its half leverage counterpart will go from 100, it'll drop 25%, go to 75, and then it'll increase 50% to 112.5. The base ETF is flat, and the half leverage ETF is positive. So this is the opposite effect. But do we want to be long a half leveraged ETF long term? The answer is no, and you'll see in some charts later as to why exactly that is. And if we don't want to be long a half leveraged ETF long term, despite it having a positive effect in its volatility drag, then what makes 1x ideal? Of course, the theme is that it isn't, but what exactly is the answer? And the answer, according to the paper, is shown here. Using indices going back to 1885 and ending in 2009, the ideal daily leverage is right around 2. And in this case, 3 is very obviously worse than 1, and 4 leads to a negative return in the long term due to too much volatility drag. It also shows some other fantastic examples of this across history, like the S&P from 1950 to 2009, not including the Great Depression, where 3x leveraged is actually the ideal amount. But in most other instances, 2 is the best. From 1928 to 2009 in the Dow, 2 is around the best, as is the case in almost all of the rest of them, except for the Nikkei from 1984 to 2009, where obviously it had a negative return. What's interesting here is that half leverage in this case actually had a positive return due to the effects that we just described, in that there was actually a positive volatility drag in this instance, and obviously across this time frame there was a lot of volatility. So that's very interesting. But across all the other time frames, 2x was decidedly the best. The problem is that they don't show a lot of charts of this, and even if they did, they would probably be logarithmic. It is nice to view these things in linear fashion and really see the differences more visibly across time. And there are some examples that I'm going to create for you now, going back to 2011 with the modern ETFs that we have, and then I'm going to go back a bit further and create charts going back to the time frames they allocated, or at least longer time frames. If we start with the S&P 500 and go back to 2015, in this case 3x was the best because this has been an incredible bull run with very little decline. But if we go to semiconductors and do the same thing, we can really see this start to play out, where the 1 times leverage returned 600%, 3 times leverage returned 1300%, still beyond 1x because this again was an incredibly bullish period, but even despite this being a very bullish period, 2 times leverage was by far the champion, outpacing both by a very wide margin. And these are some great examples in recent history, but obviously we have only seen a bull run across recent history. This does not include any significant drawdowns where the main arguments against leveraged investing come from. So let's make our own charts and include those instances and make these charts linear as well so that we can see the true differences. These are the charts that I have made. The original index in this case is the Dow from 1900 until present time. This does not include fees or anything else that may weigh on these ETFs over time, just the pure calculations, including exclusively the leverage decay associated with rebalancing. In this case scenario, without those other factors, 2x is the clear winner across history, outperforming by a vast margin. 3x still outperforms the original index in this case scenario by a pretty significant margin. This, however, does not take into account fees associated with management or interest rates, which of course fluctuate over time. But I thought I would include this to show that both in this case, 2x and 3x would outperform the benchmark if they did not have those fees associated. Now I am going to include those fees. The expense ratio in TQQQ is around 0.88%, which is what I am going to use for both the 3x and 2x in this situation. With the addition of that expense ratio, things get brought back down to earth a bit. 3x now underperforms the original index, however 2x outperforms significantly still, as was suggested in the paper. This is very interesting. We can now look at specific periods in history and compare the performances of these ETFs. Let's start with the beginning. This includes the time period prior to and following the Great Depression. As we can see, over the 20-year period prior to the Roaring Twenties, where markets stayed largely flat, the original index outperformed because it was not experiencing these fees or the decay. As we go up into the top of the bubble, even at the very top, 2x was still the best performer. 3x was a close second. Quickly after the top, the original ETF returned to being the best performer, and 3x quickly became the worst performer. Going towards the lows, the original ETF was by far the best performer, the 3x went to nearly zero, and the 2x went fairly low as well. Moving into the next period of time, including the final end of the Roaring Twenties, the Great Depression, and the large bull market following, we see the following. The 3x leverage ETF had an incredible run towards the top in 1929, where it outperformed by an unbelievable margin, and it quickly became the worst performer into the Great Depression, never to recover. Across this period, this 30-plus year time frame, the original ETF, the Dow, was the best performer by a significant margin. 2x was a close second, and 3x was a nowhere near close third. If we skip past the initial part of the decline in the Great Depression, we see that this does not change. However, if we move a bit closer to the low, however not right on it, we see things shift drastically. 3x becomes the best performer, 2x the second best, and the Dow, the original, the worst by far. Perhaps this is a case for dollar cost averaging. However, that would be a lot harder to simulate, though perhaps we can do that in a future video. The swings here are incredibly interesting, I will say. If we move to the final best stages of this bull run, from 50 until 67, we can see that 3x is the utter and complete outperformer by a vast margin, because in this case there were not many significant drawdowns and the time frame is not long enough for the expenses to take a significant toll. Of course, everyone wonders about the 70s, and if we showcase the 70s, this is what we'll find. Across this sideways market, the original, the Dow, was up across this period. The 2x leveraged was down, the 3x was down even more significantly, as you would expect. The next period will of course be one of the most incredible in history, and even though it does include the 1987 crash, 3x still outperforms by an unbelievable margin. Do note that this axis does not start at zero. That is just how extensive the returns of the 3x was in this case, due to there being no notable declines across this entire period. However, if we extend this to include the worst of the great financial crisis, while 3x does still outperform because of how incredible the 1980 to 2000 bull run was, 2x does come back into the lead at the very end. If we're a bit less lenient with our start date, this does not change. 3x and 2x both outperform the benchmark, but the 2x does lead in this case. And one thing worth note is that in 2008, the original index obviously got past the 2000 high as the Dow did. The 2x did as well, but the 3x did not get above its 2000 peak, as we're about to explore. If we take off some of the tech bubble returns, we now move into an environment where the 3x ETF is by far the most significant underperformer, and the original ETF is again the only one in the green. And if we exclusively show recent history, starting in 2000, the 3x mostly matched the Dow, and the 2x excelled with significant outperformance. And as this demonstrates in many occasions, the 3x ETF performs exceedingly well in significant bull runs, better than you could possibly imagine, but also, of course, faces by far the most amount of decay, so that it is nearly unrecoverable after significant drawdowns. It would be interesting to model dollar cost averaging into this. If you'd like me to do that, let me know. If you think that there are any things that I've missed in this video in terms of expense ratios and how I could perhaps factor interest rates into this, because obviously those expense ratios likely would have been higher in the 70s as a result of borrowing cost and other things being more expensive for the ETFs themselves. If you have ideas on how I can better format that into this, please let me know. Or if perhaps I could look at different indices, perhaps the Nikkei over time, semiconductors, or anything else. Now that I have the framework to do this, it would be very easy to implement these changes, as long as I save the code, which I intend to. For now, it seems we have given a bit more life to the original paper via linear charting, and we have shown that this does appear accurate throughout history, and we can return to this chart to say that what we did and what they did yielded somewhat similar results. 3x was worse than 1x, and 2x was the best. And it's very nice that we are able to go back in time and model all of these things, at least mostly accurately, to get a picture of what these things look like. I think that modeling dollar cost averaging would be the next step, and perhaps I will take the journey to do so. For now, I think it's worth concluding that 2 times leverage is likely the best to hold across history, though there are very long periods of time in which this is not the case for any leverage, and there are of course also times where leverage works extraordinarily well. It all depends on your time horizon. A lot of leverage across a bad time horizon, of course, does not age very well. But if you have enough of a time horizon, it does seem as though they tend to recover and outperform. I don't think there's too much more to discuss here. Like, subscribe, that's about it.